On June 4th, the American stock market sat just below a record high. At the very same moment, Bitcoin broke to a 4-month low, down to $61,000. A record at the top, a collapse below it, on the same day. And the money is being pulled out from both ends. A $1.77 trillion SpaceX public offering, the largest in history, is days away, set to drain $75 billion out of the market. Even Alphabet, the most cash-rich company on Earth, just raised $85 billion more. So where is the edge now? It isn't in the crowd being drained dry, the hype, or the evidence, and this issue is the evidence. This is the asymmetric, Issue 6, the drain, tech and crypto investing for thoughtful retail from an operator's lens. Issue 4 named the tell, a wave of mega-issuance. Issue 5 watched the first lever break when strategy sold Bitcoin. This issue watches the money drain out of the speculative end of the market and into the artificial intelligence build-out. The market is being drained from both ends at once. On the supply side, the artificial intelligence build-out has become a capital vacuum. Alphabet, a company that generated $174 billion of operating cash flow, still filed to raise around $80 to $85 billion more, and Berkshire Hathaway took $10 billion of it. A $1.77 trillion SpaceX offering is 8 days from pulling $75 billion more. On the demand side, the speculative dollar is being pulled the other way. Bitcoin broke below 65,000 to a 4-month low. Part 1, the macro regime and the liquidity that just tightened. The 30-second frame. The Federal Reserve is on hold, between 3.5% and 3.75%, with its next meeting in mid-June. But a hot jobs print just pushed the 10-year Treasury to about 4.5%, and the market now prices 0 rate cuts this year. Gold holds near $4,500. The S&P eased back from its record, near 7,530, and Bitcoin broke to a 4-month low. This isn't a crash signal, it's a liquidity squeeze. Start with rates. A private payrolls report showed about 122,000 jobs added in May, beating expectations, the kind of number that removes the case for easing. The 10-year jumped to 4.49%. The market has now drained the rate cut out entirely. 0 cuts this year is the leading outcome, near 70%, and core inflation forecasts have been revised up toward 2.8. The discount rate has stopped falling. A tailwind for near-term cash, and a killer for long-duration, no cash flow assets. Now the capital vacuum. On June 1st, Alphabet filed an automatic shelf and priced a cascade of offerings through June 4th, an equity program of roughly $80 to $85 billion, including a $10 billion private placement bought by Berkshire Hathaway, on top of more than $85 billion of debt raised over the prior year. The purpose? Fund $180 to $190 billion of capital spending, almost all of it artificial intelligence infrastructure. When the company that needs the money least raises this hard, the build-out has become a system-level capital vacuum, pulling from public and private markets at once, even as private artificial intelligence funding stays red-hot. That shows up in the structure of the market. The S&P set back-to-back records into June 2nd, then eased to about 7,530, down 0.33%, as the cut hope drained and yields rose. The top 10 names are still about 36% of the index, and the demand under the build-out is confirmed, not slowing. Broadcom just delivered a beat and raise, with artificial intelligence chip revenue up 143%. The capex Alphabet is funding is landing as real revenue, which is exactly why the marginal dollar keeps rotating out of crypto and into artificial intelligence equity. 2 more pieces. Gold is holding near $4,500 an ounce, even as real yields rise, the cleanest sign that the central bank reserve bid is structural, not a momentum trade. And oil snapped back. West Texas crude near $95, up from the high 80s, as the energy risk premium repriced on renewed Iran tension. But the politics are tilting toward de-escalation. The House passed an Iran War Powers Resolution 215 to 208. Energy is a genuinely two-way tale on a complacent tape. Part 2, in focus, grounded in the filings, the data, the debate, and the mechanism. The lead is Alphabet. Over the last 12 months, it generated $174 billion of operating cash flow, and it still raised around $85 billion in fresh capital. The bull case: this is confidence, not distress, locking in cheap capital from a position of strength, and Berkshire Hathaway's $10 billion vote says the compute return is real. The bear case: the signal is the size. When the company that needs money least raises the most. Every dollar the cohort pulls in is a dollar drained from the rest of the market, and $180 billion is being spent ahead of proven return into 4.5% money. The read: own the quality end of the build-out, not the speculative proxies, but be patient on entry. The other side of the drain is crypto. Bitcoin broke below the $65,000 line we drew last issue, falling to a 4-month low near 62,000. Ethereum fell below 1,800, and roughly $200 billion of crypto value was erased in a single day. Bitcoin has now given back every gain it made since the Iran war began, trading like a pure risk asset, not a safe haven. The driver is explicit: institutions rotating the marginal dollar out of crypto and into artificial intelligence. The structural thesis is intact. The tactical setup is a falling knife. With 65,000 broken, the next lines are the 200-week moving average and the $60,000 zone. Part 3: how to read a market pulled from both ends. First, follow the vacuum but don't stand in front of the hose. Own what the build-out must buy: power, gas, and electrical equipment, where the spending lands as someone else's cash flow, not your dilution. Second, the cut is gone, so price money accordingly. Duration is a liability again. Third, own the asset, not the lever on it. Capital wants gold's unencumbered store of value over the financial engineering version. What we are watching this week: the SpaceX public offering on June 12th, the cleanest read on whether the issuance vacuum has a demand limit, whether Bitcoin holds the $60,000 zone and its 200-week moving average, whether the deleveraging spreads from crypto into equities, the Federal Reserve meeting on June 16th and 17th, where the risk is a hawkish surprise, not a cut, and any labor or inflation data that could revive the rate cut story. And we keep score in public. Alphabet, the quality end of the build-out, patient on entry. SpaceX, watch the print. Bitcoin, broke support, entry sensitive. Strategy, avoid the proxy. Gold, constructive. Cigna and EQT, attractive and constructive. Eaton, watchlist, full price. These are dated, falsifiable calls, and we grade them. So where does it land? The market is being drained from both ends. The artificial intelligence build-out is a system-level capital vacuum. Own what it must buy, not the shares it prints. The discount rate has stopped falling, the killer for long-duration assets and the reason Bitcoin broke. And the edge is unchanged, uncrowded, cash-generative, unlevered. Energy, buried quality like Cigna, the hard asset over its derivatives, and the quality end of the build-out, plus dry powder. That's the drain. The asymmetric turns filings, flows, and market data into one disciplined read for investors who want the evidence, not the noise. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.